Right, let's just jump straight into this explainer. We're looking at a huge question today. How do you actually balance that aggressive hunt for high returns with the frankly terrifying reality of market risk? It's kind of the ultimate dilemma for anyone trying to build serious long-term wealth. You want that fantastic growth that outpaces inflation, right? But you definitely don't want to be losing sleep every single time the stock market has a bit of a hiccup.
So to figure this out, we're going to cover 6 key things today. 1. Defining mid-cap funds. 2. Historical performance. 3. Volatility and risk. 4. Key fund metrics. 5. Peers and benchmarks. And finally, 6. Assessing long-term growth.
All right, starting with part 1, defining mid-cap funds, the sweet spot of investing.
Before we tear into the data of a specific fund, we kind of need to lay the groundwork. What exactly is a mid-cap fund? Well, it basically sits right in what we call the sweet spot of investing. Think of the market like a massive ecosystem. At one end, you've got your large caps. These are the giant established companies. Very stable, great for preserving your capital, but maybe not the fastest growers. On the flip side, you have small caps, super volatile, but with explosive growth potential. Mid-caps strike this really fascinating balance in the middle. They target companies that have already survived their chaotic small-cap days and proven their business models, but they still have that agility and rapid growth potential that the massive large caps just literally don't have anymore.
Okay, moving on to Section 2, Historical Performance, a Legacy of Wealth Creation.
Now that we know why mid-caps are so appealing, let's look at the actual track record of the Nippon India Growth Mid-Cap Fund. This thing is an absolute veteran. Tracing its roots way back to 1995, it actually started out as the Reliance Growth Fund. It's one of the oldest and most resilient, actively managed equity schemes in India. It has survived and honestly thrived through crazy economic cycles and major regulatory shifts. Interestingly, around 2023, the fund made a notable shift toward a lower turnover, disciplined buy-and-hold strategy. And today, it commands a massive asset under management of over 47,400 crores. That is huge.
And this number right here is exactly why it survived and pulled in so much money. Since its inception nearly 30 years ago, it has delivered a staggering compounded annual growth rate of 21.94%. Yeah, you heard that right. Decades of compounding at nearly 22% is pretty much the textbook definition of serious wealth creation.
Which brings us to Section 3, Volatility and Risk, the engine and the brakes.
Look, we all know high returns don't happen without high volatility. It's just the nature of the beast. But what's super fascinating here is how the fund managers actually build this portfolio to protect conservative investors when the market inevitably takes a hit. They use what's best described as an engine and brakes structure. The roughly 69% mid-cap allocation acts as the alpha-generating engine. That's your aggressive growth. But then, there's an unusually high large-cap allocation of about 21%. That acts as the brakes. Compared to other mid-cap funds, holding this much in large caps is pretty unique. It acts as a structural stabilizer, giving the fund crucial liquidity and softening the blow during severe market crashes. It's quite literally a built-in shock absorber.
Let's dive into Section 4, Key Fund Metrics, Decoding the Jargon.
So to really see how those brakes actually work in the real world, we need to cut through some heavy financial jargon. If you're a beginner trying to figure out long-term capital growth, these are the metrics you absolutely have to know. First up, standard deviation. Honestly, just think of this as the bounciness of the fund. Depending on the time frame you're looking at, this fund sits between 15.78 and 18.1. Simply put, it means this fund is slightly more bouncy or volatile than its category average. But hey, don't panic. That's totally expected for a high-conviction fund that takes actual, decisive sector bets instead of just blindly copying the index.
Next up is beta, and this is a big one. Beta basically measures the fund's sensitivity to broad market movements. So if the overall market drops 10%, does this fund drop more or less than that? Well, despite that internal bounciness we just talked about, this fund boasts a beta between 0.92 and 0.97. Because it's less than 1, it tells us the fund has historically been slightly less risky and less reactive than the broader market itself. Remember those 21% large cap breaks we saw earlier? Yeah, this is exactly where they prove their worth.
And then there's alpha. You can simply think of alpha as the manager's personal skill score. It's the extra return earned beyond what the fund's beta and the market's performance would naturally predict. Nippon India posts a very healthy positive alpha, ranging from 1.44 to 2.51. In the world of active management, this is the holy grail. It absolutely proves the managers are adding real value through smart, bottom-up stock picking, not just getting lucky and riding the overall market wave.
All right, Section 5,
Peers and benchmarks, the competitive edge.
Now, risk metrics are great and all, but theory doesn't pay the bills, right? Let's talk actual returns against the competition and the benchmark, the NIFTY Midcap 150 TRI. Just look at the consistency across the board here. Whether it's the 1-year, 3-year, or 5-year mark, this fund clearly beats both the benchmark and the category average by roughly 2 to 4%. And let me tell you, in the world of compounding, a 2 to 4% annual outperformance over a 5-year stretch, that creates a massive, massive difference in the final size of your portfolio.
Let's put this into perspective by comparing it with another heavyweight, like the HDFC Midcap Opportunities Fund. You can really see the stylistic difference here. Nippon is all about that high-conviction, differentiated bet. They are totally fine with a slightly higher standard deviation if it means capturing that alpha through a disciplined buy-and-hold approach. HDFC, meanwhile, plays it a bit more conservative and highly diversified. Now, neither approach is wrong, but Nippon's strategy is very explicitly built to be the aggressive growth engine in a portfolio while still keeping that large cap buffer for safety.
Finally, Section 6, Assessing Long-Term Growth. Is this for you? All right, we've covered the history, the mechanics, the metrics, all of it. But what does it mean for you as an investor? Well, because of that bounciness we went over, the data paints a very clear picture. This fund is absolutely not for day traders or anyone with a weak stomach. It is strictly for folks who are looking at an investment horizon of 7 years or more. Midcaps can and do go through long periods of just moving sideways. The absolute best way to play this? Systematic investment plans, or SIPs. By putting in a fixed amount regularly, you actually use that volatility to your advantage, buying more units when the market dips and just riding the wave over the long haul.
So here's the ultimate question I want to leave you with today. Taking into account that powerful mid-cap engine and those stabilizing large-cap breaks we just analyzed, do you actually have the stomach for the short-term volatility required to unlock true long-term capital compounding? Think about it, and let that guide your next portfolio review. Thanks so much for joining me on this explainer, and keep learning.